Afternoon, everybody. I'm Nick Spencer-Skeen. I am the Senior Executive Officer at Lunaro Markets Limited in the Abu Dhabi Global Markets ADGM, and we're regulated by the FSRA as a Category 2 entity. And I'm also Director of Lunaro Financial Services Limited UK, which is a regulated FCA company. I'd like to welcome you all to our latest webinar in this new series and introduce you to our host today, Alex Mahoney. Alex is today going to be talking about options. So this is a subject dear to my heart because a lot of my early career was defined by the options market and open outcry trading. Alex is the head of macro trading strategy at AlphaPix. It's a cross-asset investment team. They provide easily digestible institutional level research and trade ideas to their 10,000 plus subscriber base, which includes institutions, corporates and retail clients alike. Previously, Alex spent 7 years at Citibank, where he served as an FX trader. He also holds a master's degree in finance from the University of London, alongside his investment advice diploma from the Chartered Institute of Securities and Investments, CISI. So we will hold a Q&A at the end of this session. I hope it is interesting to everybody and we get some interesting questions. But on that note, I will hand over to Alex and all over to you, my friend.
Brilliant. Thanks, Nick. And good morning, good afternoon, good evening, everyone, wherever you're based around the world. Similar to Nick, options trading is something that's near and dear to my heart as well. I find the options market arguably one of the most interesting sort of products to trade. It's an incredibly interesting product to break down. And really, in terms of what we're looking at here today, this is something that in economics and finance modules at universities, people will spend several weeks or even months digesting options. We're going to provide a very sort of high level overview of options trading today. And please, as Nick said, if you find this interesting, let us know, because there's certainly scope for us to do follow-up options webinars in more detail on different elements of them. But certainly for today, we want to look at options basics because there's sort of a slight shroud of mystery around options for some traders, particularly retail traders, that think these are just purely instruments traded by institutions and hedge funds. But in reality, if you can have a good working understanding of options, the risk and reward behind it, how you can define your risk by trading options, they're a really powerful tool to have in your arsenal as a trader. So to begin with, let's have a look at options basics. So understanding what is the product we're talking about. Now, the definition I was always given and work off is that an option is a right, but not the obligation to buy or sell a particular underlying asset for a particular notional amount between now and a fixed expiry date. So as you can see on our slide here, it has the definitions and the different bullet points. But really what we're talking about here is that as the buyer of an option, you outlay an upfront premium. And for that premium, that gives you the optionality we talked to, but essentially it gives you the ability to buy or sell an asset at a particular price level for a period in time. Now, options are defined either as being a call or a put option. So a call is where you can buy, and a put option gives you the right to sell. Now, as well as giving you the ability to either have a call or a put in your arsenal, as an option, you can also buy or sell the product. So if you buy an option, which is what we're going to spend the majority of today looking at, because when we're talking about having defined risk, buying an option has defined risk. When you buy an option, you outlay the initial premium. And once you've paid that premium, that is the maximum loss that you could sustain from entering an options contract. Now, right away, you can see that's one of the major appeals of buying options, because when you're looking at entering a trade, be it at spot or on a futures contract or other different potential ways, an option's really nice because you know right from the outset of the trade, okay, I'm going to risk X amount of dollars, and that is going to be my maximum loss on the product. Now, obviously, as you can see on this slide, you can also sell options, which is the inverse, and essentially you receive a premium, and there are popular option trading strategies where you effectively sell multiple options and you use that as a source of income. But obviously, selling options can be risky because you don't have defined risk. And if the market goes against you, then obviously you can face a significant loss. Now, in terms of sort of visualizing the dynamics of buying and selling, in this case, a call option, the little diagrams are often very popular to look at. So on the left-hand side, we have the profit and loss for someone who buys a call option. And as you can see in the blue, where it says the premium, from the outset, you do incur a loss, and that loss is the size of the premium paid. So for example, let's say you're buying an option on NVIDIA shares and you pay $1,000 for that option. From day one, you are down $1,000. But as you'll note from the chart, that is a flat horizontal line. So that is your maximum profit, maximum loss that you will take from that options contract. Now, if the price of the underlying asset, in this case, NVIDIA shares, goes up in value, then as you can see from the left-hand chart, well, you start to come into profit the higher the price of NVIDIA shares goes. And the nice thing about a call option is that the profit is potentially unlimited. If NVIDIA, over the course of your options contract, goes through the roof, then you can benefit in all of that upside participation. In contrast, if you look at the right-hand chart, selling a call option, well, from day one, you're in profit because you receive the premium that the buyer has paid you. And if the market and NVIDIA shares don't move from where you sold your option through to expiry, then you get to bank that premium as a profit. However, the risk is that if the price of the underlying asset increases, in this case, NVIDIA shares, then ultimately the higher it goes, the bigger your loss when you sell that option, because you have to deliver the shares at the agreed on price on expiry. And obviously, the higher that NVIDIA stock goes, the bigger the difference is from where you agreed it at. So in terms of the option basics, the next thing to look at is what are the different factors involved when trying to look at an option? Because you can understand the theory of, okay, this is what an option, this is what it does, but we're starting to digest now more, okay, well, how do I actually put this into practical terms? So what you can see here is a Bloomberg, an option pricing ticket. So this is sort of a lot of the information a professional trader would look at when they were trying to build an option. And I appreciate there's a lot of numbers and different things to digest here. But all I want you to focus on is the three yellow rectangles and what's in there. So in this case, this is an option, a call option on sterling dollar. So it's a currency option. Now, the first big factor to vary is the expiry. So you'll notice in the yellow, the first box, it says expiry 3 months. So when you're looking at taking out an option and having a view on, let's say, sterling dollar, one of the big factors to decide is, well, what time frame do I want to express my view on? Do I think sterling dollar to buy a call option is going to appreciate over the next 24 hours? Or is it going to be as here, 3 months? Or do I want to go even longer to, let's say, a year, even 2 years out? So depending on your view, the time to expiry is a variable that you can increase or decrease. The other big factor, as you'll see in the second yellow box, is what's called the strike. So in this case, our strike price for our call option on sterling dollar is 135. Now, essentially, when you look at the strike price relative to the market price, you have a decision to make. Because in this case, sterling dollar is trading in the 134s. So your strike here at 135 is quite close to where the market is. Now you might think, okay, well that's good because if I think sterling dollar is going to appreciate, I want to put my strike as low as possible so that the market, if it does rally, I can make a lot of profit. Well, to some extent that's true, but what you have to remember is that the strike price, the closer it is to the market, the more expensive it's going to be, the higher the premium you're going to have to pay. So you might think, okay, well, in that case, then let me put my strike miles away from where the market is, because that's going to cheapen the premium. Well, again, you're kind of right. That is true. But if we put our strike so far away from where the market is, then the chances of the market rallying to that level over our period of time starts to decrease massively. So the picking of the strike is really important because you want to try and get it not so far away from where you think the market's going to go, that the probability of it getting there is just tiny, but also not so close to the market that you're paying an excessive amount for the premium. So picking an expiry and a strike are two of the most important things when it comes to structuring the option trade that you want to get. And at the very bottom, to put it all together, the final yellow box you can see there is the price. So in this case, a 3-month call option on sterling dollar with a strike of 135 is going to cost me just over 1%. And to interpret this in everyday language is that if this option is going to cost me 1%, then let's say the notional value of my option is $100,000, then I'm going to lay out $1,000, 1% of that in my upfront premium. So that's the way to sort of think about that premium as a price. So now you've got an idea of what an option is, some of the variable factors of it. You might think, well, okay, so when am I actually going to want to use options versus other products in my repertoire? Well, one of the big ones, and as we allude to in the title, and something we're going to come on to later on, is that it provides us with defined risk. Now, what do we mean by this? Well, we can take directional exposure on, let's say, sterling dollar via a spot transaction, or via a CFD or a spread bet. But when we do that, if the market moves lower, obviously we lose. If the market rallies, we win. So to some extent, we do have defined risk if we put a stop loss on the bottom. But if we don't set a stop loss on our CFD or a spread bet, our losses are potentially unlimited. Now, with an option, we do have defined risk completely off the bat, because whatever that premium is as an option buyer, that is our risk, our defined risk we know, and it's quantified. And that's a really big advantage and why people like using options in the first place. Another point is that options can be used really effectively to hedge a portfolio. Now, for those of you that have joined us for our webinars in the past, we did one on futures a few months ago and looked at how you can use futures as a potential hedge, but also options can be used as a potential hedge. So let's go back to our example of NVIDIA shares. Let's say in your portfolio, you own X amount of NVIDIA shares, and you know that the earnings call is coming up next week. Well, you might think, I don't want to sell all of my stock, but I am a little bit worried about what might happen over the earnings call. Well, an option could then be used. So you could look at buying a put option, which would profit if the market came lower. You could pick your expiry. So you could say, okay, well, I'm going to buy one for, let's say, 3 days. So it expires after the earnings announcement, but doesn't go on forever. And I know that because of that, I'm going to need to pay $500 or $1,000 as an upfront premium. But I know that that basically hedges my NVIDIA position, because if NVIDIA shares do fall in the aftermath of earnings, well, then because of my option, that's going to be profitable, which can help to offset the loss from owning the stock. So options as a hedging tool, very, very powerful. Also, we can look to use options not just to take directional exposure, but even when we think and we have a view, but I think markets are going to stay range bound, or I think markets are going to be volatile. Now, again, we'll come on to this a little bit later on, but even when we don't have a directional view, options can be a tool to exploit even range-bound markets. And finally, restructuring and structuring risk and reward. And so with options, you can really clearly define and say, okay, I want 1 unit of risk, and I can look to take on 4, 5, 6 units of reward. And because of the way options are structured, that can be very appealing. So let's go on to that last point now, the risk and reward around options trading. Now, the first point to understand on this is that the risk reward for options is non-linear. Now, again, let's try and debunk as much of the jargon from this as we can. So what do we mean when we say it's non-linear? Well, as you see in the diagram here, it's similar to the one we looked at right at the beginning. But this is the diagram of that sterling dollar call option that we priced a few slides ago. Now, across the x-axis, you can see that that is the rate of sterling dollar. And so you can see that at 135 is where the slight inflection point comes, which is where our strike is. Now, the option is non-linear in the sense of our upside is completely unlimited, but our downside is capped. So as you can see from the x-axis, sterling dollar could go to 140, 142, 144, and our profit from the option would just keep rising. But at the same time, if sterling dollar fell to 134, 132, well, we know that line is flat because all we're losing is our premium, and we've capped our premium at the very outset. So when trying to look at that, you might be sort of starting to think and process, okay, well, what goes into the premium? Because if I can figure that out, then obviously I can start to structure my options trades, and you'd be correct. And when we look at premiums associated with options, there's 2 main things that go into the price of an option. The first one is the intrinsic value. And when we say the intrinsic value, remember we were talking about before where our strike level is relative to the market. So that is the intrinsic value that an option may or may not have. So if, for example, we bought a call at 130 on sterling dollar and the market's at 134, well, that call option already has intrinsic value because the market is already higher than our strike. It's already what we would say in the money. So it has intrinsic value. That's going to make the option more expensive. Conversely, if we put our call strike at 140, 145, the intrinsic value is significantly less. So the cost of the premium, again, is going to fall. The other part of the option premiums you can see there is the time value. Now, the time value refers to how short or long your time to expiry is. And as a general rule of thumb, the longer you take an option for, 12-month option versus a 1-month option, well, that 12-month option is going to be more expensive. Now, why is that? Well, you have more time value, you have more opportunity for the market to move. Now, hopefully the market moves in your favor. It might not, but we don't know that. But if you do take a longer time frame, your premium is going to be higher, all things being equal, because you're giving yourself more time, more opportunity for the market to rally. So those are the 2 key elements that go into getting a premium. And so you can already start to think about, okay, well, that's important because based on my view, based on the risk reward I want to try and stack up, I'm going to have to play around with things to make sure that the premium is cheap enough or at a particular level that I'm happy to risk my capital at in order to get the returns from there. Now, off the face of that, you might think, well, actually, I'm just going to try and get the cheapest options possible, or I'm going to avoid very expensive options. But as we'll see from a couple of real life examples, it's not so much about the actual cost of the option, but it's that risk and reward parameters that can make an option either appealing or not. So let's take a look at the first example here. This is SpaceX. obviously a stock that is very volatile since its IPO back in June. And so what we're looking at here is buying a call option on SpaceX. And what we're going to do, as you can see from the thing, is that we've done this for a year, so a 12-month option. And the strike we've picked is exactly the same as the share price. And as you can see, again, all I want you to look at is that yellow box. The price that we're paying for this option is 29.9%. So we're paying almost 30% premium upfront for this SpaceX option. Now, yes, we've given ourselves a year to go on, and we've picked a strike that's quite close to the market. But that's not to say that this option is a terrible one, because SpaceX is a volatile stock, as you know. Now, over the course of the next year, who knows? Maybe SpaceX could double in value from here. Maybe it'll triple in value. We don't know. But if I, as a trader, had a view that I thought SpaceX was going to do exceptionally well over the next year, I might look at this option premium of 30% and still think in my head, do you know what? That's fine. I'm happy to pay that premium. Because let's say I think that the market could rally 100% from here. Well, I'm paying out 30%, or effectively you can think of that as your break-even level. So I need SpaceX shares to rally 30% just for me to get to flat. But then if I think that it's going to rally significantly more than 30%, then my risk and reward can stack up. So I might look at this and actually say, do you know what? That's still a good options play from here. Now, conversely, just because an option premium might not be much, that doesn't mean that it's a good option to take either. So here we have the case of Euro Swiss, which is obviously another currency pair. And for this, we've chosen a very short expiry of 1 week. So we're taking out a call option for 1 week, and we've put our strike quite away from where the market is. Now, in the yellow box at the bottom, you can see the price here is just 0.07%. I'm paying just 7 basis points for this option. So you might think of this as like, yeah, this is cheap. Well, it's true, that is the case, but in reality, what is the probability of a low volatility currency pair like Euro Swiss over the course of the next week meaningfully going above my strike level? Well, you could argue that actually is pretty small. So just because the option is cheap, my risk reward in this case, from my perspective, wouldn't stack up. So I hope those two examples go to show a little bit of how the actual premium you pay in isolation isn't that important, but what you want to do is weigh it up against the potential reward, and from that's how you compute if the option is worthwhile or not. So now let's go on to defined risk strategies and look at some of the ways you can actually implement some of these option trading in your actual portfolio. And as we do this and as we go through, I know Nick mentioned at the outset, we've got a Q&A at the end in a few minutes, but if you do have any points, observations or questions as we go through these, feel free, put them in the chat, and obviously we can see them, address them as we go as well. So the most conventional one, or the most, I don't want to say easy, one of the steps and the options that many people start with is the conventional one of buying a vanilla call put and being long on both. Now with this, as we've stressed before, you have your defined risk. When you buy the call or buy the put, you pay out your premium, and that's where you know is your defined risk. And taking on this type of style really works best when you have that strong directional view. So let's say sterling dollar, and keep to our original example. If we have a strong feeling that the market is really going to ratchet higher, sterling is going to appreciate in value against the dollar, then a long call could be best play. But there are other variations. And when I mentioned at the beginning why options trading for me is one of the most interesting products to structure, is because there are pretty much limitless ways that you can package up calls and puts and variations of them to build ideas that offer more of a specific and niche view. Now, we won't go into too many of these for the moment, but I just wanted to flag a couple so you get a little flavor of what you can do here. So this next idea is a call spread. So let's say you had your view on sterling dollar, but you thought, actually, yeah, I think sterling dollar is going to appreciate in value, but relatively so. I think this could get up to 140, maybe a little bit higher, but this isn't going to 150 or beyond over the next 3 months. So in that case, you might say, well, what I'm happy to do then is I'm going to buy my original call at 135, benefit if it moves in my favor, but I'm happy to cap my potential reward beyond a particular level, 137, 140, whatever it is. And what you can do is you can then sell a call at that higher strike and receive a premium for it. So what that does is that lowers your overall cost of constructing the product. So you still pay for your 135 call, but because you receive something from selling the higher strike call, your overall cost is lower than it would be if you were just buying the outright call. Now, this works well if, yes, you want to reduce the cost of the premium you're paying. And also, if you have a view that I think the market's going to stay between a particular range, then this can be an effective way to, yes, limit potentially some of your upside, but also reduce some of your upfront cost. So that's just an example of a different way of thinking about it and putting together two options in one. Now, we mentioned towards the beginning that one of the benefits of trading options is also, even if you don't have a directional view, you can make a play on something like volatility. So this is a good example here. So there are two main strategies associated around volatility. One is a straddle, one is a strangle, very similar products. As you'll see in our little diagram here, this is essentially a straddle. And so what that involves is buying a call and a put at the same strike where the market is, or close to the market. And what you're essentially playing for here is that the market is going to be very volatile and move either higher or lower to an extensive degree, to the point at which either of your options stands to be profitable. So if the market soars in value, yes, the put is going to be worthless, but you're going to make money on your call option. And conversely, if the market tumbles, well, you'll make money off your put option and the call option will be worthless. But if you don't have a clear view on something, but you're going into a central bank meeting, even a company earnings call or a big data release, and you're not sure, but you think, actually, do you know what? I think the market isn't priced right here, or I think people aren't expecting as big of a print as I think is going to come out, then a volatility play via options can be very effective. And also, again, as we drum on and on with your defined risk, you pay the premium for both of these options. And essentially, if the market doesn't move, as you can see from the diagram, if it doesn't go higher or lower below our white line, then we do lose because we lose our premiums. But beyond those premiums, that's our maximum loss. So making this play on volatility can be very appealing. So before we take questions, we'll go into some of the sort of trading takeaways that we've looked at, because I appreciate that it is a lot of information to digest over the course of just half an hour. So the first thing that goes into with our options is having our view, because the same with any product that we trade is that you have to start off with your own view, your conviction, to look to put on a trade in the first place. So have our view. Is it a directional view? Do I think the currency, the commodity, the equity is going to move higher or lower? Do I make it a play on a range? Is it a volatility play, as we just looked at? View am I trying to express in the? Then once we have our view, then the next 2 points come into play, expiry and the strike level. So if I'm playing a Fed meeting or a company earnings call, my expiry only really needs to cover that period of time. If it's a broader macro view, the state of an economy or other elements like that, well, then maybe I want to go months or potentially years into the future. And then there comes the strike, where it's a really finely balanced tuning exercise between the probability and where I want to put the strike. Obviously, the lower the strike is, the more intrinsic value that I'm going to have in it, the more expensive it's going to be. But if I put my strike too far away from the market, it's never going to stand a chance getting. And then finally, which is the fourth point, is what is the risk to reward? Does it stack up? Because you could go through, you could have your view, you could pick a time frame, pick a strike, but if you look at the trade and the cost of it, and then potentially where you expect the market to go, if that risk reward doesn't stack up, it's back to the drawing. And potentially then you look at having the same view, utilizing it via a futures contract or the spot market via another product. So risk and reward comes at the end because that's the last check to see, is this the right trade to be put on via option? It might be, in which case this all stacks up. Okay, let's go for it. If it doesn't stack up, then maybe, as I said, we change the product, or maybe options are correct, but you just need to tweak your strike a little bit or change your expiry a little bit to try and make sure that you have a good gauge. So that's a little summary of what we've looked at this morning. Need to go and take some questions.
Thank you very much, Alex. It's great. So actually, an interesting question just came in. What tools are easily available to visualize payoff functions, P&L, outside of Bloomberg, which obviously is a very expensive tool to use?
Yes, yeah, that's a very good question. So in terms of looking at options and option pricing, or you can see for free some places such as the CME Group, some other brokers, you can see essentially an option strip. So from that, you can look at, they'll put a list of different strikes. So let's say that go up in sort of set increments, and they will show you the price of that option, and then obviously the different strikes above and beyond it, and the difference in cost for it. In terms of looking at the payoffs, that I admit that is harder to find. Yeah, so I do know some smart people that have built themselves in Excel little payoff metrics. But if you can't get the size payoffs, thing you can obviously do is you can look at not sort of generalizing too much, but you can look at the cost of the option that you're paying, let's say 1%, and you can look at the expected move in, let's say, the stock, and say, okay, well, if I expect this stock to move 10% and the premium is 1%, you can garner some risk reward calculations from it. And that is the assumption that it gets there by expiry. Obviously, between expiry, then it's harder to model for free tools. But, yeah, it's a good tool.
Okay. Another quick one. What are some of the common mistakes new option traders make?
Yeah, well, I think one of the big ones is forgetting that this is still a product that's traded with leverage, essentially. So, like a futures contract that's leveraged. The options contract, you pay a premium of 1%, let's say, and that's exactly what it is. It's 1% of total contract with the size of 100%. So, in terms of the sizing that you're taking on, again, think about overexposing yourself to it, taking on too big of a premium. So again, if you're looking at, if you have a trading account of $10,000, then does it make sense to outlay $5,000 on option premiums and scaling to have a big notional? You stand to risk 50% of your overall book in those trades. So I'd say one of the biggest things is people get the concept of defined risk, overexpose themselves as a result, end up with too much of an exposure.
Okay. Another question. I'll try and cut this down slightly. Do you think there's like still a big gap in option education? And then what advice would you have for retail traders who want to take their first steps into trading options?
Yes. So yeah, I still do think that options in general is a market doesn't have enough education around it. I think part of it is in the pricing dynamics and pricing tools that essentially expensive and still are expensive to be able to be shared at a sort of mass market level. So I think that's why option trading still hasn't got mass appeal. And in terms of sort of taking first steps into trading options, I say as we looked at today, it's really looking at just starting with vanilla buying long calls, long puts, and getting used to seeing, yeah, exposure it takes you on, how your P&L moves as the underlying moves, because so much we haven't talked about today. Probably your favorite topics, Nick, the Greeks, in terms of your delta and all the elements like that that go into the changing elements of it. So I'd say to take the first steps is to take it the basic levels, a call and a put, and experiment with them. And then from there, as you feel more confident, then you can start to look at combining different options. I think that the main thing really is just to get comfortable with the fluctuations in the profit and loss over the course of an options life.
Yeah, I think there is some good literature out there as well. Actually, it's made me think. I'm now going to go and Google whether Shelley Natenberg's books are still online and
In
published because he's
circulation.
well, yeah. Well, Shelley Natenberg is probably the greatest option trainer of all time. He taught most of the people who traded actually on the pits and open outcry. Anyway, it's an interesting question. Should I always hold my option to expiry?
Yeah, another fantastic question. So the beauty of an option, obviously, there are two types to this extent. It's an American and a European. So it depends which options you have. But if we keep it simple, the option in theory allows you to hold it or close it out at any point of the option's time frame. So you can hold your option to expire if you want. See, then it takes you through the settlement process. Some are obviously cash settled, etc., physically settled. But you do have the option, certainly if you're trading American options, to close it out at any point over the options life. So the benefit that that flexibility gives you is that if you do see a fast move, say if you buy a call and a couple of days later you see a big move in your favor, then you can look to crystallize that profit straight away. So there is flexibility in that option, and certainly there's no pressure to hold an option to expiry if your scenario that you were looking for has played out in advance of expiry.
Okay. Oh, well, while you're answering that, I did actually Google, and there's actually a lot of very good educational publications out there, and Shelley Natenberg is still available on Amazon.com. So it is out there from an educational point of view. People just want to kind of Google it because there's some very, very good literature that actually explains things in language that we can all understand ourselves. I think the final one. Where's there some scenarios where somebody might want to sell options?
Yes. So selling options in itself is probably another webinar in its entirety. I mean, so you alluded to it a little bit, but there are option strategies around selling options, which is more geared around a sort of income distribution strategy, because when you sell an option, you pick up that premium. And the reason we haven't really dwelled on selling options too much here is because this was about defined risk, with when option buyer is the case. When you sell an option, if you sell a call, you have a potentially unlimited risk from that perspective. But in theory, the occasions when someone would want to sell an option, the primary one is if they're looking for income distribution, and that ties in with their view that the market isn't going to go against them. So let's say they expect a stock to fall in value, well, they could buy a put for sure, or they could sell a call. And if they sell a call and the market does fall, then obviously they pick up their premium, get to keep it. So it is a little bit just about having the view and how you want to express that view. And then the other reason why people would sell options is as part of an overall structure. So we looked at the call spread there, which involves buying an option, selling a higher strike. Well, in that part, as part of that, you do sell an option as part of it. So potentially you sell options as part of a strategy. Otherwise, it's often used as a way for income.
Okay, I've got a couple of other quick ones before we finalise. Quick one, outside of a premium paid, are there any other costs, e.g. commission, financing? I could probably answer that myself. Basically, it's generally just going to be a commission charge, which obviously if you're trading on exchanges will be made up of the exchange fees and your broker's commission. Probably financing wouldn't come into that. I've never come across financing for option traders. Couple of our quick ones. For a client who's bullish but wants to cap a downsize, how do you compare a debit call spread versus a covered call in terms of capital efficiency and margin treatment?
Oh, that's a great question. That's someone knows what they're talking about. Sorry, Nick, you'll have to give me that to me one more time. I got the first bit lost of it.
Uh, so for a client who's bullish but wants
Yeah,
to cap their downside, how do you compare a debit call spread versus a covered call in terms of capital efficiency and margin treatment? Um,
sure.
it might be quite a difficult one to just answer in a couple of lines, and we may need to come back to that in writing, I think.
Yes, I would say happy to give a more formal write-up on that. Yeah. I mean, so the for everyone, I suppose referring to there is the client essentially owns the underlying asset, so the shares in this scenario, and he wants to protect his downside to protect that the market's going to fall. So there's a couple of ways that he can do. He mentions a covered call. So a covered call is essentially where you sell a call option on a stock you already own. So that means it's covered in the sense of if you do end up having to deliver the shares, you already own them, so you're not sort of naked in that respect. And then the other option, as you said, is a debit call spread. And we looked at obviously a call spread in the webinar earlier. The debit or the credit part of it essentially just refers to if you're receiving money, if you're paying money for that call spread. And a debit is essentially when you pay for that call spread. But yeah, what I'd say is in terms of answering that question, I'll happily write up something so that everyone's not to listen to it.
Well, I've got a couple of other questions that make me think we need to do a slightly more advanced webinar in after this one. So I'm going to leave those for that time because I think it does delve much deeper into sort of implied volatility and other areas that are sort of bread and butter for me, but actually people need to get their head around. One quick one: how does buying options compare to using futures contracts with a stop?
Yeah, so that's a definitely a good question there. So obviously the slight difference is that with the futures element, we do have the linear element that we were talking about. So even with having a stop loss, if you're entering a futures contract, the market moves lower 2%, market moves high 2%, it's still linear. Whereas with an option, you do have that non-linear element. So you pay your premium, but on the upside, the stock might move 5%, but the actual option might increase in value by 50%. So that's not to do with the leverage, that's just to do with how the option works. So whereas with a futures contract, you get leverage, but it's still linear in terms of if a stock goes up 5%, the futures contract should go up 5%. With an option, you benefit, the stock might go up 5%, the actual option might go up 50%. So Futures is still sort of linear in terms of your risk reward, whereas an option is
I'll add one extra little piece on that, or two little pieces on that one. When you buy an option, you pay one commission and one premium. And as you said, we know it is a defined loss if the market goes the wrong way. And if you're using a stop loss on a future, number one, there's no guarantee your stop loss will be hit at the correct level because there may be slippage depending on liquidity in the market. And secondly, if you do get stopped out, you've got to pay another commission on another futures contract. So an option, you only pay the commission once. On a future, if you're using a stop loss, you're going to pay two commissions, one for your buy, one for your sell, and all the rated exchange fees. So I think on that note, I think it's probably time we wrap it up, but I'd like to thank everybody who has joined us today. It is one of my favorite subjects, options, and anyone wants to ask me for the details on the educational stuff, I'm more than happy to assist on that one. Just come to our support channel at Lunaro and I can give you the links for the right authors to be reading on this subject matter. And I certainly think we can go and delve deeper into options in a future session as well if the interest is there from participants. So thank you everybody for joining, whether it's the morning, afternoon or evening, wherever you are. Thank you once again, Alex, and I think we have another one coming up in a month's time. So look forward to seeing everybody there.
Thanks, everybody.
Thank you very much, everybody. It's been a pleasure.